Happy Sunday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. It has been a huge week for markets around the world. Obviously, we need to do one more episode today on Sunday, an extra episode for the week, so we're on top of the main trends as we move into what will no doubt also be a very busy economic, financial, and market-focused week. Let's jump in. On Friday, Wall Street closed one of its worst weeks since the pandemic, as steep losses swept across global markets in response to a deepening trade war between the United States and China. The S&P 500 plunged more than 10% over 2 days, including a 6% drop on Friday, its worst performance since the onset of the COVID-19 pandemic in 2020. The Nasdaq composite, heavily weighed towards technology stocks, officially entered bear market territory after shredding 5.8%. The sharp declines followed China's sweeping retaliatory measures against President Trump's newly announced tariffs. Beijing imposed a 34% levy on all U.S. goods and barred 11 major American firms from doing business in the country. Customs authorities also halted chicken imports from 5 of the largest U.S. agricultural exporters. Beijing's new retaliatory duty pushed the country's average tariff on U.S. imports up to about 50%, marking a significant escalation. The U.S. agricultural industry is bracing for the potential of tens of billions of dollars in losses. China, which consumes 14% of all U.S. agricultural exports, took in more than $27 billion worth of those and related products last year, according to the U.S. Department of Agriculture. It is the third largest importer of American farm goods, behind Mexico and Canada. David Ortega, a professor of food economics and policy at Michigan State University, observed on Friday, quote, "If these tariffs go into effect for a significant period, we're likely looking at a disruption that is likely to be severe and likely worse than the 2018 trade war." In saying all this, however, as we discussed on my other channel, China Update yesterday, China is much more vulnerable to a protracted trade war than the United States, as it is far more reliant on the US market than the other way around. It has a trade surplus in the hundreds of billions of dollars. So while some sectors in the US will hurt because of these tariffs, Chinese industry, which desperately needs foreign markets to sell to, will feel much more pain. Meanwhile, oil markets were quick to react on Friday too. The global benchmark for crude slumped to its lowest level in over 3 years as investors feared the disrupted trade flows would slash global demand for energy and commodities. Meanwhile, the broader economic outlook darkened despite a surprisingly strong US jobs report showing 228,000 positions added last month. US President Donald Trump touted the job figures, well above expectations, proof that his policies were strengthening the economy. Quote, "Great job numbers, far better than expected, it's already working," end quote, he posted on Truth Social. However, economists warn that the data preceded the full impact of the new tariffs. Federal Reserve Chair Jerome Powell struck a more cautious tone, warning that the trade war could fuel higher inflation while slowing economic growth. The uncertainty has rocked corporate boardrooms too. A wave of high-profile IPOs has been put on ice, including offerings from Klarna, eToro, StubHub, and Midline Industries, the latter aiming for a $50 billion valuation. Jeremy Abelson, founder of Irving Investors, observed, quote, "The market is justifiably reacting in an aggressive way. A company would be irresponsible to go out in this environment," end quote. The mergers and acquisitions market has also cooled. Data from Accelerate Financial Technologies showed average spreads on US deals over $100 million have widened significantly, signaling traders growing skepticism that deals will close. The fallout is yet another blow to dealmakers who had pinned hopes on a revitalized market under the new president's second term. Instead, equity bankers are scaling back. Forecasts are preparing for a lean year. As Apollo Global's Jim Zelter observed on Friday, quote, "There is vision in C-suites and boardrooms, but the practical reality is that things have come to a stop," end quote. Trade experts are warning that the tariffs could create a virtual trade wall around the United States economy, amounting to nearly $1 trillion. According to Trade Partnership Worldwide, the estimated cost for US businesses will be $654 billion annually. This figure excludes additional tariffs under the International Emergency Economic Powers Act and Section 232 tariffs on steel, aluminium, and autos, which could add up to $300 billion more. As a result, American companies will face an estimated $1 to $2 billion in daily costs by 2026. As volatility grips global markets and companies retreat from ambitious plans, the economic consequences of a deepening trade war are becoming clear. With over $5.4 trillion in market value erased in just days, Wall Street and the world now face a reckoning. Some are taking the long view, however, saying that the trend of protectionism and resetting the global trade order has been a bipartisan one in the US for years now. Brown University's Mark Blythe, for example, observed on Friday, quote, "Ending the current trade system will be massively disruptive, no doubt, and the prospect of US reindustrialization may prove illusory. But it is important to remember that both parties see it as necessary. The rebalancing began before Trump arrived on the scene and is being driven by forces that may outlast him." End quote. When a system is reset, the disruption can be seismic, and that is what we are experiencing currently. And it is likely going to get worse before it gets better. Indeed, next week is going to be a big week. If you want to join us as we follow this historic shift in the global order, international finance, economic and trade flows, consider subscribing to Market Update. Hit the bell notification icon and you'll be on top of the most up-to-date news and analysis. And if you're getting some value from today's episode of Market Update, don't forget to hit the like button. I'd also like to take a quick opportunity, if I may, to express my deepest gratitude and thanks to you all. This channel is now 3 weeks old. This is the end of the third week since I launched my second channel on YouTube, and it has already reached 10,000 subscribers. My first channel, China Update, took 2 years to reach 1,000 subscribers. To reach 10,000 in 3 weeks is amazing. It is deeply humbling. I appreciate all the support and all the feedback from you all. I sure picked a wonderful time to launch a market-focused channel, just as the world is going through such seismic changes on the market and financial front. My commitment here is exactly the same as my commitment on China Update, that is grounded and sober analysis, a channel that is primarily subscriber-supported and not reliant on corporate funding, and a fully independent channel that is just me. I very much look forward to continuing with this channel, growing it, and continuing on this journey of understanding this complex world that is going through such seismic changes. And I very much appreciate that you all have decided to come along with me on that journey. Thank you. Next up, let's now move to Europe. With President Trump's sweeping new tariffs, companies across the European Union are scrambling to adapt, with the United States, the world's largest consumer market by a country mile, threatening to impose 20% tariffs across the board and up to 50% on key goods like cars. Many businesses are eyeing alternative markets. The next biggest options are the EU itself and then China. This has raised one question in particular in recent days, which is, will this new trade order push Europe closer to China? Well, Europe and China have not been the best of trade partners. The EU has frequently criticized Beijing's economic policies, from overproduction to dumping cheap goods on global markets. Political disagreements, especially over China's stance on Russia's war in Ukraine, have only highlighted tensions. Still, some see a chance for cautious cooperation, driven not by trust, but by necessity. Recent talks between EU and Chinese officials hint at a possible thaw. After raising tariffs on Chinese electric vehicles last year, the EU has now agreed to resume discussions, including pricing and supply chains. Yet experts warn that this moment is more likely to drive the two economies further apart. As China faces reduced access to American consumers, it may flood European markets with cheap exports, intensifying fears of dumping and unfair trade. Indeed, Macron made this very warning on Thursday of this week. And it is at this point that a commentator often quoted on China Update, my other channel, has to make his debut on Market Update. Yesterday, Beijing-based Peking University professor of finance Michael Pettis observed, quote, "Some analysts argue that U.S. tariffs will force China and the EU closer together, as each diverts its exports from the US to the other. That assumes that either the EU is willing to replace the US as consumer of last resort for excess Chinese manufacturing capacity, or that China will play that role for the EU. The former will be extremely painful for the EU, while the latter is all but impossible. The point is that what had seemed like a stable global trading regime was in fact based on an unsustainable dependence of the rest of the world on the willingness of the US, along with the UK and Canada, to exchange ownership of domestic assets for large trade deficits. The key role of the United States in the global trading system, in other words, has been not as importer, but rather as net importer. China and the EU, consequently, cannot solve their problems by finding other importers. They must find other net importers. End quote. And the only net importer of significant size, especially compared to economies as big as China and the EU, is the United States. And as we saw this week, the United States, at least under the current administration, is no longer happy with the status quo. Next up, now with so much heavy news with crashing markets and global trade wars in recent days, as we move on to Asia now, let's end on something completely different and much lighter. Earlier this week, Japanese gaming company Nintendo officially announced that its much-anticipated Switch 2 console will launch globally on the 5th of June. Priced at $449 US in the United States, the announcement made via Nintendo Direct drew over 2.4 million viewers in Japan alone. Analysts say the premium price reflects both upgraded hardware and concerns over supply chains amid looming trade tariffs. Designed to function both as a home console and a handheld device, the Switch 2 sports a larger 7.9-inch screen, improved high-definition graphics, and a built-in voice chat feature with optional facial projection using a new camera accessory. Nintendo is betting big on legacy and innovation. The console retains compatibility with current Switch software and will launch alongside Mario Kart World. Major developers like Capcom are also on board, with a new Street Fighter installment in development. Gaming is a massive industry. In 2024, gaming revenue dwarfed film and music revenue combined. Now, we do need to bring this part of the video back to tariffs just quickly, as yesterday Nintendo announced a delay in US pre-orders for the upcoming console due to new tariffs. Though the console is still scheduled for release on the 5th of June at a price of $450, Americans eager to secure the device early will have to wait. The company said it needs time to, quote, assess the potential impact of tariffs and evolving market conditions, end quote, before setting a new pre-order date. The rates of 34% on Chinese goods and 46% on Vietnamese imports are expected to hit electronics hard. Nintendo, which manufactures much of its hardware in Asia, is among the companies affected. With 150.8 million units sold, the original Switch remains a titan in gaming history. Nintendo's financial outlook heavily relies on Switch 2's performance. Gaming made up nearly 94% of its revenue last financial year. As mobile gaming continues to dominate globally, Switch 2 must prove that immersive visuals and tactile controls still matter in an increasingly touch-screen world. Okay, that is today's episode of Market Update and the final one for this week. I hope you enjoyed this extra weekend edition of Market Update. Thank you very much for watching. Have a good weekend, have a restful weekend, and I will see you for what will no doubt be a very eventful and busy new week tomorrow on Monday.